The Stage 3 tax cuts are controversial. They're expected to cost $254 billion over the decade after they're introduced in July 2024. That's a lot of money.
In the first year these tax cuts are introduced, they're going to cost the federal budget about $20 billion, almost twice as much as what it spends on higher education.
So how do they work, and who do they really benefit?
High-income earners do quite well out of it. Low-income earners get nothing, and middle-income earners get a little bit, but not a lot.
If you're earning the big bucks, more than $200,000 a year, you'll see a saving of more than $9,000 at tax time. But what about the rest of us? Say someone earning the average full-time wage or the minimum wage. Most people will pay more tax than they did last year. It all comes down to three things: the Stage 3 tax cuts, something nicknamed the Lamington, and a phenomenon known as bracket creep. So what could that mean for you? Let's talk about tax. To understand how your taxes are changing, you have to understand how the system works. Don't worry, it's not that complicated, I promise. Let's say you're a barrister earning $200,000 a year. When it's said that people in the top tax bracket have a marginal tax rate of 45 cents in the dollar, that doesn't mean they're paying 45 cents on every dollar they earn. At the moment, there are 5 tax brackets, and every dollar you earn falls into one of them. Here's how those marginal tax rates work in 2022-2023. On your first $18,200, you'll pay no tax. That's the tax-free threshold. On your next $26,800, you'll pay 19% tax. On your next $75,000, you'll pay 32.5% tax. On your next $60,000, you'll pay 37% tax. And if you're lucky enough to earn more than that, for every dollar afterwards, you'll pay 45% tax. So now that you've had a crash course in marginal tax rates, let's go through the Stage 3 tax cuts, the winners and the losers. Stage 3 removes a whole tax bracket, the 37% one. It lowers the tax rate on one of the remaining brackets from 32.5% to 30% and lifts the income threshold for the top tax bracket from $180,000 to $200,000. On the face of it, it seems like a big win for middle and upper middle income earners. But the real winners are high income earners.
What we found is that the share of tax paid by the top 10% of income earners will fall, whereas the share being paid by the middle 68% of taxpayers will actually increase.
Now let's compare how the Stage 3 tax cuts would affect 3 different people: a teacher, a barrister, and a barista. A teacher earning $98,000, the current average full-time wage, will save $1,325 in tax in the 2024-25 financial year. A barrister earning $200,000 a year would be the biggest winner, saving $9,075 a year. On the other hand, the barista making their coffee, earning let's say $45,000, just above the minimum wage, will get a tax saving of exactly $0 from the Stage 3 tax cuts. To be fair, they will have already received savings of $1,080 a year from Stages 1 and 2 of the tax package, implemented a few years ago. But that's it. There's nothing extra for them in 2024-25. That's where the Lamington comes in. It's the nickname for the low and middle income tax offset. It's basically a fancy name for a tax cashback when you submit your return. Last financial year, the Lamington added $1,275 to the tax return of someone earning $45,000 a year. But it was only temporary, and now it's gone. So when our barista files their tax return after July this year, they'll be missing out on nearly $1,300 that they got last year. But the reality is, while high income earners will pay less tax over the longer term due to these tax changes, low and middle income earners will still end up paying more. And then there's something called bracket creep.
We're getting rid of bracket creep. Bracket creep is a thief.
Why do you want to keep them?
Oh, look, we've said in principle that returning bracket creep is a worthy objective.
Governments like bracket creep because it's tax by stealth.
But what is bracket creep? Let's imagine you're earning $45,000 a year, just on the cusp of the next tax bracket. Inflation's pretty high at the moment, around 7%, so you ask your boss for a pay rise. You get a 3% boost to help you deal with inflation, about $1,350 extra a year. Your annual income then totals $46,350, bumping you up into the next tax bracket. You're not actually earning more though, because inflation's gone higher and your money doesn't go as far as it used to. But the government gets to tax your extra $1,350 at the higher tax rate. This could be overcome if the government moved tax brackets in line with inflation or wage growth, but it's in their interest not to.
Those with lower incomes, the tax cuts were very minimal, so it hasn't managed to offset their bracket creep.
The result is a dramatic change in who gets to keep what and income distribution across Australian society.
So they're unfair, and that money instead could be going to getting dental into Medicare to relieve the cost of living crisis.
It is to strike the best balance between what we need to do to fund the services and programs and investments in the future that people expect, at the same time as we do modest but meaningful tax reforms.
With the government expected to keep spending a lot more than it raises in revenue well into the future, what's called a structural deficit, a lot of experts say the Stage 3 tax cuts are an obvious place to start fixing the budget.
You probably do want to give some tax cuts, but they're simply too large in the current fiscal environment.
Probably look at that 37 cents in the dollar rate and returning that. That makes things a lot more equitable in terms of the distribution of the tax changes in that whole system.
The Prime Minister and the Treasurer will need to ask themselves, what price are they willing to pay to keep their promises?